Here are 3 stocks that I'm going to be buying in October if the stock price hits the value that I need it to hit. So what's the first stock? Visa. This is something that most everybody has in their pocket right now. It's $274 a share. Now, why do I like Visa? Well, it's really for the reason that I just said. Somebody has it in their pocket. Everybody has it in their pocket. I mean, I'm going to pull, well, my phone's over there. I want to see how many. I think I have 3 in my pocket right now between debit cards and credit cards. They are exclusive to some sports teams out there. I think they might be exclusive to the NFL. Visa is one of those companies that is truly a staple, not only just in the United States, but around the world. And if we just come over here and look at some of the quick metrics of it, it's a $557 billion company with an enterprise value of $592 billion. The difference between these two numbers is the debt. That, to me, really doesn't worry me in this situation. Something that really, really, really excites me when it comes to this company is this gross profit margin down here. Guys, that number is 80%. And if you look at their 5-year profit margin, it's about 52%. Now, what do you notice that's right above that? Nearly 55%. So that means that the profit margin is increasing. Something else that I really like about this, kind of 50-50 on it. If you look at credit card debt in this country, we are currently sitting at absolute record levels. Now, is that good overall? I don't know, but you know who it's going to benefit greatly? A company like Visa. So that's probably why things are getting better for them. I look at the PE, the 12-month PE and the 5-year PE. Do these numbers seem ridiculous? Historically, you think maybe an average PE of about 16, 17, 18. But when you're looking at a company like Visa, do you want to pay some type of big premium for them? To me, I do, just because this company is not really a moat. By definition, they're not really a moat. But if you kind of put 3 companies into a moat, I'm going to put MasterCard in there, Visa, and American Express. They kind of split that moat status. To me, that's something very, very important and something that I would pay a premium for. 5-year return on invested capital of 20%. They allocate their money well. That number is clearly increasing. They're sitting about 24% over the last 12 months. If you look at their free cash flow over the last 5 years is about just a shade under $16 billion. 5-year net income. The free cash flow is higher. Love seeing that. There are not a lot of things on here that I dislike. And something out there for you dividend investors or people that enjoy getting dividends. When I look at a dividend and I see, okay, we're sitting at about just a shade under 1%. They're paying out $4 billion. The next thing I'm going to do is go and look at their cash flow, and they can more than afford this. I hate when companies, let's say that they were generating, let's say that this number was $4 billion. And they're paying out $4 billion. Why are you paying out your entire free cash flow? They're not doing that. This is a fraction of it. It's not even 30% of what this is. More than affordable. It's a good way to reward the customer or the shareholder if there's nothing else to do with that cash. Let's move on a little bit further. I want to look at go to the income statement. The numbers just keep getting better. You can see revenue just continuously increasing. Did it get a big jump right here because of COVID? Yes. Is this sustainable? I do think it's sustainable, specifically because where we're sitting in this market cycle of crazy debt in this country. They're buying back shares. Not sure I love that, but they've been doing that on a very consistent basis forever. It seems like every year they just buy back shares. I don't necessarily love that, but it is what it is. Expectation is exactly what I thought. High 5-year price to free cash flow. High PE, well, greater than 22.5. Everything else is a check mark, which tells me this company could possibly be overvalued. I don't know. Let's see what the analysts have to say quickly. Wow, good revenue growth. And they haven't even tapped in. I look at countries like Africa, India, China. They have not fully immersed themselves in those markets like we have in the United States. Going from $10.12 earning per share to $17.44 by September of 2028. That is phenomenal earnings per share growth. If you look at revenue growth, it's about 10% consistent. Let's go over to Stock Analyzer tool. You can see it's on my watch list for 270. So here are my numbers. I have revenue growth in there of 9%. I think that's a pretty safe number to be at. Profit margin, I rarely put in anything over 50%, 52%, same for free cash flow margin. I actually could see myself cranking that up a little bit, and I put in 10% right there just so we could see intrinsic value today. Let's click Analyze and drop it down. $256. So this, to me, makes sense that it's at 270. Now, why don't we do something here? Why don't we go pay a bigger premium for this? Let's go 25. Let's go 25 here. There you go. So if we really want to pay a premium here, 25 PE, then it is absolutely in the wheelhouse. This is a company that I am selling puts on right now. Will I get assigned these shares? If value drops, yes, I will get assigned these shares, but this is a company that I'm very excited about right now. Now, speaking of stocks that I am excited for, let's go into the luxury space. Louis Vuitton. Louis Vuitton is a company that I really get excited about. Right now, it's about $154 a share. This, to me, I don't like putting a recession-proof term on things, but I do like saying there are companies out there that are going to do better and be very well sustained throughout a recession. Recessions don't hurt the typical Louis Vuitton, the consistent Louis Vuitton spender. Are they going to see a dip? Absolutely. People that have been flushed with cash over the last 5, 6, 7 years, they are probably going to drop off because they were buying Louis Vuitton when they had extra money and government was giving away free money. Why don't you go do it? I mean, it's incredible the brands that they own that you don't even know that they own. So let's just come down here and look at a couple of things. $386 billion market cap, enterprise value of $461 billion. That's the debt between it. Because these are tangible items, they have factories, they have transportations. I'm not super worried about that. If we just look at a couple of more metrics here, this is something that really shocks me. In this space, nearly a 70% gross profit margin. That is wild. Again, same thing, 16% over the last 5 years of profit margin. What do you notice? Nearly 18%. So the profit margin is increasing. I love seeing that. They're currently sitting at a PE of about 23, a 5-year PE of about 32. So let's go and see, have they been buying back any shares? Make sure we're on annual. Okay, so this is a company that is extremely consistent. Yes, they've been buying back marginal shares. But if you look, 2014, 2.51 billion shares outstanding, got it to 2.52 here, 2.52, and now they're down to 2.5. So they really don't, they take that money, if this is of value, and go buy back shares. There's so much better to do with that $8 billion of cash than pay it out as a dividend, especially out of your, what did I say, $12 billion free cash flow. Yes, about $12 billion free cash flow. I can't say I love that. Let's go see the pillars. Again, a lot of these pillars you're going to notice, maybe not the last one, but these you're going to notice, I have two metrics that are X's. They're my valuation metrics. So our 5-year free cash flow is high, 5-year PE is high. But again, is it high? It's high based on history, if you want to compare it to historical values. But this is a brand that is a staple. Not only a staple in the States, but a staple around the world, especially the Louis Vuitton brand with the LV. Everybody wants to have the LV on them. Now, Louis Vuitton is about $154 a share. Something that has changed greatly in me over the past several years was I would look at this and say, Louis Vuitton is a fantastic product. Everybody has them. Everybody wants them. I'm going to go buy the stock. It doesn't work that way. I have since found that numbers truly matter. And having people to talk about those numbers with, other value investors, is also what really matters. I chat in the community. I'm going to open a conversation today about Louis Vuitton because it is getting so close to my number in our community and say, guys, give me your feedback on what you see from Louis Vuitton. That's the great thing about it. I don't have to sit secluded in a room, sit at my desk and have nobody to talk to and make that decision. I can go and find other opinions. Maybe people will say, hey, you're missing this. And that is a great thing to see. So if you go to everythingmoney.com, you will see that we have a limited number of daily spots for our community and software. The reason for that is the software currently includes everything that we have, from retirement to real estate to stocks. As we expand, we are going to have to make changes, and the current offer of everything is going to be expanded. So the current offer is going to be going away very soon. You may remember that when we first started this, Paul had the software built, and people would see Paul in videos and say, hey, how do I get that software? So Paul said, well, this is an expensive endeavor, but you know what? Let's make it. Let's give the people what they want. So as the community has grown and as the channel has grown, it's becoming way less about us and more about you and how we can serve you and serve the community members that use the software. Now, the good news is that these changes have not been made yet, but we're working on them every single day. So if you join today, you'll be grandfathered in for life with all the data, all the tools that we've made. You'll get all of that and stay in your pricing tier forever. So if you're really serious about making better financial decisions, probably increasing your returns, but more importantly, sleeping better at night, making less irrational and emotional decisions, Click on the link in the description below to get access to the software before we make these changes. I'm very confident this is going to be one of the best financial decisions that you've made. Now, let's see what my value is on Louis Vuitton based on the assumptions that I have made. You can see here. Let's break this down. I love seeing this. Increasing ROIC. Like I said, why are you paying this dividend if you're getting better at investing in yourself? Revenue growth. I put in 8%. Profit margin and free cash flow margin of 15%. I did give them a very high premium of 25 PE and price to free cash flow, and I put in a 10% return, no margin of safety, just so we could see intrinsic value, and that comes out $167.50 a share. So this is another company I'm going to be selling puts on. Now, the last company, I actually own this one. I do own shares of this, but it's something that I am interested in owning more of, especially as the value drops. That is Tidewater. Tidewater is sitting, and many of you may not have heard of this one. Tidewater is sitting at about $72 a share. You can see the road that they've been on over the past 5 years. It's been explosion. There's been some hiccups in there, and you can see lately, look at this. It hit an all-time high. Well, maybe not all-time high. It hit a high recently of $111 a share, and now it's sitting at 72. To me, I started buying this at 100. Am I worried about that? No, I'm going to be dollar cost averaging to this thing because right now I see even at 100, when this was $100 a share, I saw incredible value at $100 a share. So now at 72, I'm seeing really incredible value. I'm looking at this for the long period of time. This is a company that has vessels. The great thing about them is they are going to dominate the space, the entire waterway of Africa. They are going to be absolutely dominating that space. They are in such a great asset position that their entire fleet is worth more than this market cap. It's absolutely incredible to see what is going on. That is how you find value. But if you look at the numbers here. Compare this to Visa. Compare this to Louis Vuitton. Profit margin over the last 5 years, negative. Average net income over the last 5 years, negative. This is how you find value, guys. You look at these things that are beaten down. Return on invested capital over the last 5 years. You can see it's picking up over the last year. You can see all these numbers are picking up over the last year. Free cash flow over the last 5 years, 37 million, 184 over the last 12 months. Net income, same thing. You can see it was negative. Now it's positive 161 million. Profit margin, negative. This is where things are beaten down. This is where I implore a lot of you guys to go find. I'm not saying go buy every company that looks like garbage on paper. You go buy them and say value is going to come out of here. But if the story makes sense, guys, I found this in the community. I found this from a community member. They brought it to my attention and they said, what do you think about this? And I was like, it looks terrible, but let's start digging in because there's some things here, namely these, that go, oh, things are getting better. Maybe it was just a hiccup in the road. So let's go and look here. This tells you the story. To me, I'm not really worried about it, especially because they have the 6 to 8% buyback plan going in. Debt. This is a very, 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 very capital-intense business. This I'm not paying much attention to. ROIC, we saw that number is increasing. So the story that this tells is not very accurate unless you dig a little bit deeper. And that's the great thing about the 8 pillars, but also the great thing about the community. You can actually go and dig a little bit deeper. So if we come over here to analyst estimates, let's see what the analysts have to say. Well, they clearly get it. Going from this December to December of 2026, $4.80 a share to $12.90 a share. Guys, don't just go buy this because I bought it or literally anybody else on the internet tells you to go buy something. Go and do your own research, chat with other people, read about different things, understand what you're buying. Of revenue, 1.4 billion going to 1.9 billion. I think that can be significantly higher, but as you can see, that is some serious revenue growth. If we come over to the stock analyzer tool, let's see here. So I put in revenue growth of 16%. I could probably drop that number, but I'm going to go 16%. Profit margin, I'm going to put 8%. I'm just going to go with these little hybrid numbers, and these are just starting points. I'm not giving them any type of crazy premium. 17 PE, and I'm going to put in intrinsic 10% profit, 10% margin of safety, which is my desired return. I would crank this up if I was you looking at this, but we are looking right now, based on my assumptions up there, at $77. So because we're sitting at 72, because I started a position at 100 and below, I am certainly looking at this, selling more puts, collecting more premium on that, and these three stocks are really companies that I would like to hold for a very long time. Now, if you want to see some other stocks that are in the value zone, click this video right here and go check them out.